You've seen it happen 3 times this month. A sudden surge in price, a break above local resistance, and just as you move your capital in, the floor gives out. Your position is swept away in another engineered bull trap. Right now, the price charts are flashing green. This localized bounce is convincing retail traders to ignore the structural damage still visible on the higher timeframes. This upward movement is a mechanical consequence of the high correlation between digital assets and traditional equities. To survive the volatility of the next few days, you need a precise map of the current market structure. By the end of this breakdown, you will know the exact price levels where market makers have laid traps to liquidate late buyers. Welcome back to Crypto Whale Radar, where we analyze the structural data and liquidation maps currently driving the market. Navigating the next 72 hours means turning off your gut feelings. We are going to rely strictly on the raw data of structural resistance to protect your capital. Right now, Bitcoin is not trading independently. It is locked in a strict algorithmic correlation with the US stock market. Where equities go, digital assets are forced to follow. Look at this chart comparing the two assets. Yesterday, the 4-hour RSI for the S&P 500 plunged deep into extreme oversold territory. That technical extreme triggered this exact bounce. Crypto is simply catching the algorithmic draft of the stock market's short-term reliefs. But zoom out. Do not mistake a 4-hour correction for a weekly trend. On the weekly time frame, the macro trend remains strictly bearish. This localized green candle is a temporary blip trapped inside a massive downward channel. The weekly supertrend indicator is still flashing red. We are still playing out massive bearish divergences on the weekly chart. The overriding pressure is firmly pushing the price down. Confusing a mechanical 4-hour pause in selling for a full weekly trend reversal is exactly why retail traders are stepping into traps and getting liquidated today. Let's map the specific architectural boundaries dictating Bitcoin's price action right now. Over the last few days, buyers have established a hard, short-term floor. The immediate support zone is tightly packed between $65,500 and $66,000. If that $65,000 floor breaks and we see confirmed candle closes below it, there is very little catching the price. The next immediate structural target to the downside is the $62,000 to $63,000 range. On the upside, Bitcoin is staring down a heavy gauntlet of sellers. The immediate roadblock blocking upward momentum sits firmly between $69,000 and $69,500. Until we see the price meaningfully breach one of these predefined walls with confirmed volume, any movement inside this middle zone is purely algorithmic noise. But there is a hidden target driving this noise. This liquidation heat map shows a massive concentration of leveraged capital resting just above $72,000. This heavy cluster of liquidity acts as a directional magnet. It naturally pulls the short-term price upward as market makers seek to sweep those clustered positions. But the trap is set right in front of the price. There is a massive structural blockade sitting intentionally between $71,000 and $72,000. You cannot reach the magnet without fighting through that thick wall of sellers. While Bitcoin attempts to fight through this gauntlet, a few select altcoins are quietly printing rare algorithmic divergences that will dictate the trading action for the next 48 hours. Knowing there is a liquidity magnet at 72K means absolutely nothing if you fail to map the deliberate blockades designed to stop you from cashing in on it. To capitalize on these specific altcoin setups, your execution infrastructure has to be flawless. Surviving a choppy, high-beta market means you cannot afford slippage or lag. That is exactly why I execute my trades exclusively on the BingX exchange. BingX consistently provides the most reliable platform and the precise liquidity conditions required for this specific market environment. If you use the link in the description, you don't just secure major deposit bonuses. You gain exclusive access to direct one-on-one trading communication with me. And to make sure you never miss the critical technical levels we track, hit the subscribe button for Crypto Whale Radar right now. Looking at the altcoin baseline, Ethereum is purely mirroring Bitcoin's relief action. It just triggered a perfect bounce directly off the 1910 to 1930 support zone, driven entirely by its own 4-hour oversold signal. But that bounce is already running into a ceiling. Ethereum is now staring down strong structural resistance firmly established between 2150 and 2200. Ethereum currently lacks independent momentum, functioning as a high beta extension of Bitcoin's price action. But beneath Ethereum's baseline, genuine algorithmic divergences are starting to form on key assets. Look at XRP. Price is aggressively printing lower lows, but the 4-hour RSI is simultaneously printing higher lows, a confirmed bullish divergence. At the same time, XRP's structural support is holding incredibly firm at the 1.30 to 1.40 zone. This specific structure tells us the intense selling pressure is exhausting. It implies a pause in bearish action, leaning heavily toward choppy, sideways to upward relief over the coming days. Solana is perfectly mirroring the setup. It has just confirmed its own exact 4-hour bullish divergence between price and RSI. For Solana, the architectural boundaries are clear. Major support is holding tight between $75 and $80, while previous support has flipped into heavy resistance, sitting precisely at $84.50 to $85. To be clear, these altcoin divergences do not guarantee a massive new bull run. They signal a calculated, temporary upward drift against a prevailing macro bearish trend. If you want to see the purest representation of the entire market's current posture, look at Chainlink on a multi-month view. This chart shows Chainlink perfectly trapped in a sideways channel for months. The definitive buy zone, the hard floor, is locked between $7.90 and $8.50, and the rigid take-profit zone sits directly overhead, acting as a concrete ceiling between $9.50 and $10. The data forces a specific posture. Trade the 4-hour relief while acknowledging the gravity of the weekly macro weakness. Never let a minor 4-hour bounce convince you to over-leverage a long position, as if the weekly timeframe has suddenly turned bullish. It hasn't. But mapping these precise resistance levels won't save you if you don't understand how market makers are intentionally hunting your stop losses in this sideways chop. To survive this chop without getting your capital drained, you need a specific defensive strategy. Click the video on your screen right now to learn exactly how to trade this range before you get locked out.